If you were to give me only one metric that I could look at to assess whether or not a particular stock is a good investment, it would be the level of insider buying. It is often said that an insider can sell a stock for any number of reasons, whether it's a tax reason, to pay a personal expense, or maybe they're just trying to get funds to acquire a different business. But they only buy a company's stock for one reason, and that is because they think it's undervalued and it will probably go up. And realistically, company management is the most knowledgeable people out there about their respective companies. So when you have several different insiders making rather aggressive purchase decisions in their own company stock, then it can usually be a pretty good sign. And not just purchases as, stock options that were awarded to them or something that's part of their compensation structure, but open market purchases with their own personal money. So I actually wanted to put this to the test and do this back test to find out, has aggressive insider buying in a company stock historically been proven to be a reliable indicator that retail investors can follow. So that's what I'm going to show you in this video. So for me, the biggest challenge that I faced in trying to create this backtest was actually decide what criteria do I use to isolate out these companies that most people would consider as having significant insider buying transactions. And what I decided on was one very simple metric, which is there must have been at least three different insiders of that particular company that made a purchase transaction over the course of a 90-day window. And that's really the only metric I use. So I didn't use any metric related to, for example, the size of the purchase transactions, because that can vary a lot, right? If you have one insider that is significantly more wealthy than another insider, then what's considered significant for them may not be considered significant for someone else. And just to give you an idea of what transactions I'm actually looking at, because there can be many different types of actual buying transactions. So I'll pull up Apple here, and then in the Insiders tab, we can see more recently what the insider transactions were. So it'd be something like this, where you have this open market or private purchase of securities. Versus something, for example, an exercise or conversion of a derivative security that I'm excluding. So it's just these open market purchases. And also, I'm just looking at this specifically for the year 2021, because 2021 is a year where there's been enough time that's passed since then where we can kind of see what the stock price ended up doing over the next 1 year and the next 2 years. And that's really the return information I'm going to be judging these investments on. How well did the company do over the next year and then over the next 2 years? Because if you look at all these companies and we can see, okay, based on this metric we found, a lot of companies that meet that criteria, their 1 year and 2 year returns are typically above what we're seeing with the market. And that's pretty interesting information for us. But if we do that test and we notice really there's no difference between these companies that met that criteria versus the overall market, then we know not really to place too much credence on these insider buying transactions. Although, if you think about it logically, we should place a lot of credence on it for the reasons I described earlier. But again, let's see if this is actually grounded in the data. Okay, so now I'm going to actually talk about how I went about doing this backtest. So what were the mechanics behind generating all this data? So what I did was I used the scripting engine in my website here, which is called tickernomics.com, and that's what I'm showing you here, the script that I wrote that performs this backtest. Now, if you guys have been watching my channel for a while, you know all about this website, but for those that are new, this is a website that I personally created, and it's free to use, and one of the key features of it is kind of this library of public scripts that we have that all perform different functions, one of which that I've recently added is this insider buying backtest. So what it does is it checks that one criteria that I mentioned before, where it looks for at least three unique insider transactions, insider purchase transactions over a 90-day window, and then it calculates the subsequent 1 year and 2 year returns. So it uses this function called a calc return function to do that, and then down here is all the code that does that. So I'm not going to explain the code, obviously, but that's just the general gist of it. And then I also created another script, which is called recent insider buying, which basically does the exact same thing, but for companies that currently meet that criteria. So companies that over the past 90 days, as of the day that you run the script, which companies have had significant insider buying. So at least three unique insiders having made a purchase transaction within the past 90 days. So I'll run this script now and we can see what it actually ends up looking like. And like I said, this is available for anyone to use on the website currently free of charge. So if you want to log into the website, I'll leave a link in the description and then you can run this for yourself, because this will be a useful script if when we actually end up looking at the results, if it shows that the companies that meet this condition tend to be better companies and they tend to outperform the market over a given period of time. So these are the companies that currently meet the criteria, the market cap, and then there's the number of insider transactions that have happened over the last 90 days. And then this total return is kind of what the company has returned over the past year. Um, and then I've also included just the price to book value ratio as a general valuation metric there to look at. So Apple actually meets this list, which is interesting. We also have Procter and Gamble, Costco, a few other companies that maybe some of you have heard of before. There's about, looks like a 30 or 40 companies that currently meet the criteria. So yeah, that is the mechanics of the back test. That is how I did it. Now I'll actually dive into the results. Okay, so now on to the results. So like I said, I ran this script, this insider backtest script, which generated this list of all these hypothetical companies that we could have invested in. And then I just exported into Excel. And here is the actual summarized results. So this is kind of the data here, the specific data, and then here's the actual results. So in total, there was 571 companies that met the criteria. The biggest winner was a company called AMR, or Alpha Metallurgical Resources, which ended up having a 1 year return of 568% and then a 2 year compounded return of 167%. And there were four different insiders that ended up buying that company. So this is a company that maybe some of you heard of. I think a few months ago there were some prominent value investors like Monish Pabrai that were opening positions in this company. I don't know too much about them though. The biggest loser, and this kind of shows you just how vast the range of results were in this data set, was negative 99.6%. So pretty much went to zero as a 1 year return, and then its 2 year compounded return was negative 97%. And this was Xella Technologies, which was a software company, and there was 9 different insiders that ended up buying this company before it ended up dropping by almost 100%. So again, that just kind of puts some context around this and shows that insider buying isn't always definitively going to be a bull signal. Now, this was the distribution of the 1 year returns. And interestingly enough, the largest cohort of return category we can see here is companies that lost at least 50% of their value over just 1 year. That was the most. That was almost 150 out of 571 of these companies. Now, I'm going to explain why that happened in a bit. It's a pretty simple reason why that happened. But then the next largest one is companies that were kind of in that more moderate range, for example, 0 to 25% annual return, and then much smaller as we get kind of into the more extreme positive returns, but a lot of negatives, right? Because this is 0 to losing 25%, down 25 to down 50%, and then this is down 50 or more percent. And that's just the 1 year return. And then the 2 year returns look a lot more normal, right? Kind of more of what we'd expect, where you have more companies in the moderate returns, but still over a 2 year time period, most companies ended up losing value. And if I look at this here, which is basically the percentage of companies that you would have made money on versus the ones that you would have lost money on. So when I went into this, I was thinking that the percentage of winners would be lower for the 1 year return. Because if we're looking at 2021, a 1 year return 2021 into 2022, 2022 was a pretty bad year overall for stocks, right? Versus if you look at 2 years, which is into 2023, 2023 is a pretty positive year. But what we see is it was pretty similar, but there's actually less winners when you go out 2 years, which surprised me a little bit because 2023, like I said, was a pretty positive year overall. Now, so looking at this, right, what if we assume we invest in all 571 of these companies in a giant portfolio at market cap weights? What would our returns end up being? It would have been, for a 1 year return, 3.39%. And then for a 2 year market cap weighted return, negative 4.73%. So the returns were actually better if you just held for 1 year. Now, how does this compare to the S&P 500? Well, it's essentially the complete opposite. Now, this is pretty interesting, I think. The 1 year return and by the way, so because we're assuming that we're investing in these companies all at different time periods, right? Because that 90-day window has to pass where there's, at least three different insiders that make purchase transactions in the year 2021. And then after the 90-day window is passed, that's when it's assumed you invest in them. We kind of have to calculate like a time weighted return because, we're not investing in all these companies at the same time, so we can't compare the S&P 500 to the same level. But basically, I just took an average of all the dates that it was assumed that you would have invested in the companies, and it ended up being kind of in the middle of August of 2021 is about the average. So that should be roughly equal if we were looking at it on a time-weighted return basis. So August 10th, 2021 to August 10th, 2022, the S&P 500, including dividends, returned about negative 5% in that time period. versus our market cap weighted return of this criteria was positive, right? So we beat the market essentially by looking at those companies. And this isn't something that's necessarily subject to any sort of backward looking bias because it's assuming plenty of time has passed and you can look at the company filings, you can look at all the insider transactions that have taken place, and then you make your investment, right? So this is pretty interesting. But then when you look at 2 years, right, our portfolio actually declines versus 2 years for the S&P 500, again, including dividends, it actually went up. So we kind of have the reverse, which I thought was interesting. So from what I saw from this initially, this kind of bull indicator that we're thinking of this insider buying, it specifically is much stronger if we're just looking at 1 year returns. But then I kind of looked at, okay, what companies are actually appearing in this data set here? And it was a lot of biotech companies, right? A lot of very small micro cap biotech companies. And I don't think I need to tell you this, but biotechs, it's not really an area of the market I touch. It kind of plays by its own rules where it's really less so about actual fundamentals and understanding like business models and financial statements. And it's more so about your knowledge of science and what's going on in the company overall. And it's, extremely speculative. It's much more to do with the actual FDA approvals that they can get. So I said, okay, let's just exclude all biotech companies because personally, I'm not investing in those companies anyway. So let's exclude them, and it ends up reducing it to from 571 companies to 418. So pretty significantly, right? That's a disproportionately high amount of companies we're excluding from this one specific industry. And now the returns look a lot different. So our market cap weighted 1 year return, again, assuming everything the same, so pretty much the exact same as we have calculated here, except without the biotechs, it's much higher, about 6.9%. And that is much better than what we see the S&P 500 did around the same time frame when it was a 1 year return. So again, outperforming the market. But then after 2 years, we see a negative market cap weighted return. Again, it's not as negative as when we include the biotechs, but it's still negative, and that underperforms the market. So I thought that was very interesting because it kind of shows that this level of insider buying, it's a very short-term bull indicator, right? Something that's probably only going to happen over the next 1 year. Now, maybe that's specific to the fact that I was looking at only 2021. If we spread it over many years and many different geographies, it could be different, but this is at least what the data is telling us now. And we had a much higher population of winners, so companies you would have made money on versus companies you would have lost on, versus when we included the biotechs. But still, that same pattern showed where there were less winners when you go out 2 years versus 1 year, which is a little surprising, right? Because when we go out 2 years, we're looking at 2023, which is generally very positive for stocks. And then here is the distribution of returns. It's much more normalized now that we exclude all the biotech, so we don't see so many extreme negative examples, and it's much more what we'd expect, where it's kind of this, this bell curve shape. So we have most in the 0 to 25% range, and then still more negatives though. And then again, we go out 2 years. All things considered, I say this is pretty similar. Because our data set isn't really large enough to get that, very clean looking bell curve. So pretty similar pattern overall. And then what I was kind of also interested in seeing is, does more insiders buying mean higher returns, right? So I looked at a minimum of three, but what if there's four, five, six, seven? Like the higher it goes, is there more positive returns? Is there kind of this positive correlation there? And the answer is not really. So this red line is kind of a trend line that goes through this scatter plot, which plots on this axis, the y-axis, the number of insiders that ended up making a purchase transaction in that 90-day window, and then this axis is the returns. Um, and we can see the line is basically flat, so there's essentially no correlation there. So 3 insider buys does seem to be that critical point to where once that happens, you can kind of say, okay, that's a pretty significant level of insider buying, and maybe there's something there. So in conclusion, right, it does seem that at least for the year I tested, 2021, relying on insider buying does make sense if it's a more shorter term investment, right, of around 1 year. And it almost shows as if the insiders know something about the company that would improve it over the short term that the rest of investors don't know about yet. Now, is it a foolproof strategy? Obviously not. As we can see here, most of the companies that you would have invested in, you're actually going to lose, you would have lost money on during this time frame. Yeah, that pretty much does it for this, guys. So let me know what you think of this test I did, and if you have any ideas that I could add to this to improve the test and make the data quality a bit richer. I do want to get some feedback from you guys on this because this was something that I just kind of had the idea of putting together, and I was curious to see what the results ended up being. And I thought the results were pretty interesting and, weren't exactly what I expected. I expected going into this there'd be basically no difference in the level of insider buying, but what we've learned is you can actually, from this data, tell that it's a reliable bull indicator. But yeah, let me know your thoughts and hope you enjoyed the video. Please like if you did, and if you're new to my channel, I'd appreciate it if you'd consider subscribing, and I'll see you guys in the next video.